Hello and welcome. I'm from Pro Tax Accountant, and today we're unlocking a really powerful strategy in inheritance tax planning, one that honestly far too many people overlook. It's sometimes called the charity will trick, but let's be clear, it is a smart, completely legitimate way to do two incredible things at once: support a cause that's close to your heart, and at the same time significantly cut the tax bill your family will one day face.
So, if you're a business owner, you know what it's like. You've poured your life, your sweat, your soul into building a legacy. But have you ever stopped to think about what happens when you're no longer there to protect it? You know, the single biggest threat to everything you've built, it's probably not what you think. It's not the competition, it's not a market dip. So often, it's a huge, unexpected inheritance tax bill that can literally force your family to sell the very assets you worked so hard to create. That's the problem we're going to tackle head on.
All right, so here's our game plan for today. We'll start by digging into the 40% IHT problem and, crucially, why it's becoming so much more urgent. Then we'll get to the good part, the 36% charity solution, and I'll walk you through exactly how that 10% rule works. From there, we'll focus on a specific strategy for business owners, expose the common traps you need to sidestep, and we'll finish up with practical planning steps you can take away and think about right now.
Right. First things first, before we can talk about solutions, we have to face the music and really understand the scale of the challenge we're up against. Think of inheritance tax, or IHT, as the villain of our story, and trust me, it's a pretty formidable one.
The headline number is simple, and it's pretty brutal. Here in the UK, the standard rate of inheritance tax is a flat 40%. Just let that sink in. 40% on the value of your estate above your tax-free allowances. To put it another way, for every £10 you want to leave your family over that threshold, £4 could be going straight to the taxman. It's a huge chunk.
Now, for many of you who are business owners or farmers, you might be thinking, hold on, I'm covered by BPR and APR. And for decades, you'd have been right. These two reliefs have been incredibly powerful shields, offering 100% uncapped protection. Here's a professional tip, though. While these reliefs have been the absolute cornerstone of succession planning for generations, simply relying on them without a backup plan is no longer a safe bet. The ground is definitely shifting beneath our feet. And here is the reason why. This is the critical, game-changing piece of information you need to know. From April 2026, the rules are being completely rewritten. The government is introducing a £2.5 million cap on 100% relief. Any value in your business or farm above that cap will only get 50% relief. That means half of that excess value is suddenly, bam, fully exposed to that 40% tax rate. This isn't some distant problem anymore. It makes IHT an urgent, strategic issue for many business owners right now.
So, now that we've established that new challenge, let's turn to the solution, and it really is an elegant one. This isn't just about tax saving, it's a strategic choice that opens up a whole new opportunity.
Here it is, the core promise of this whole strategy, laid out as simply as possible. By making a qualifying charitable donation of at least 10% of a specific part of your estate, the headline IHT rate for the rest of that taxable estate drops. It goes from that hefty 40% all the way down to 36%. That's a full 10% reduction in the tax rate itself, and that can create some very significant savings.
You know, this really is best described as a win-win. As one expert beautifully put it, this relief splits the cost of the charitable donation between the government and the non-charitable beneficiaries. What does that actually mean? It means the tax saving you make effectively helps to fund the gift itself. In a very real sense, the government is contributing towards your charitable legacy. It's a fantastic concept.
Okay, so it sounds great in theory, but I'm sure you're wondering, how does it actually work in practice? Let's deconstruct the mechanics behind this rule. There's no real trick here, just a very specific calculation that you have to get absolutely right.
The entire strategy hinges on one absolutely crucial figure, the baseline amount. This is the number your gift has to be 10% of. And let's be crystal clear and bust the biggest myth right now. It is not 10% of your total estate, and it is not 10% of the residue. Here's something you should know. Getting this single definition wrong is the most common reason this strategy fails, and it's a costly mistake that can completely wipe out all the intended tax savings.
So let's walk through the calculation. First, you start with the net value of a specific component of your estate. Second, you deduct any applicable reliefs like BPR, and you also take off the standard nil-rate band. That's the £325,000 everyone can leave tax-free. Third, and this is the bit that often surprises people, you then add back the value of the charitable gift itself. That final number is your baseline amount. Then you just run the test. Is your donation at least 10% of that figure? And this is where you can really see the financial power of this rule. Look at this simple example of a £900,000 estate. With no donation, the family pays a painful £230,000 in tax. But now look at the second bar. By making a £60,000 donation, the tax bill drops to just over £185,000. That's a tax saving of £44,600. So think about that for a second. The charity gets a fantastic £60,000, but the actual cost to the beneficiary's inheritance is only £15,400. That is what I call incredibly efficient philanthropy.
Okay, let's now get into the really high-value insights, specifically for you business owners. This is where that 36% rate interacts so powerfully with those big changes to business property relief that we talked about earlier.
This table tells the whole story. Before April 2026, a £4 million business could be entirely free of IHT, zero tax. But just look at the column on the right. After that date, a new tax bill of £300,000 appears out of thin air. But by using the charity strategy, you can immediately reduce that tax bill to £270,000. That's a £30,000 saving straight away. It turns the 36% rate from being a nice-to-have into an absolutely essential planning tool.
Now, things can get a little more technical here. You see, for IHT, your estate isn't just one single pot. It's actually divided into what are called components. So you have your general estate under the will, you have jointly owned assets, and you might have assets in certain trusts. The key takeaway here is that this 10% test has to be applied to each of these parts separately. And that complexity is exactly why professional advice isn't just recommended, it's absolutely essential to get it right.
And that leads us perfectly into the most common and most costly mistakes that we see people make all the time. Understanding these pitfalls is the key to making sure that your planning actually works when it matters most.
This is, without a shadow of a doubt, the most common question we get asked. It seems so logical, doesn't it? Can't I just put in my will that I want to leave 10% of whatever's left over to charity? It sounds simple, but it stems from a very dangerous misunderstanding.
It's a critical error, and here's why. The residue is calculated after all your specific gifts and debts are paid. But remember that all-important baseline amount we calculated earlier? It's worked out before some of those things are deducted. That subtle difference in calculation almost always means that a simple 10% of residue gift will be too small. It will fail the test, and your estate will be taxed at the full 40%.
So let's quickly summarize the top pitfalls to avoid. First, using a fixed sum gift that doesn't keep up as your estate grows. Second, incorrectly taking off the residence nil rate band when you're calculating the baseline. You can't do that. Third, gifting to a non-UK charity, as the rules for that have recently changed. Fourth, and this is the real solution, failing to use a professionally drafted formula-based clause in your will that guarantees you'll meet the test. And finally, overlooking very technical rules like grossing up.
So we've covered the problem, the solution, the mechanics, and the pitfalls. Now let's pivot from all this knowledge to real, tangible action. What are the lifetime planning steps you should be thinking about?
If there is one core message I want you to take away today, it's this. Proactive, lifetime planning is now absolutely essential. With those huge changes to business reliefs on the horizon, a wait-and-see approach is no longer a viable strategy. This 36% rate is a powerful tool, for sure, but it should never exist in isolation. It has to be woven into a comprehensive, professionally drafted estate plan that considers every aspect of your wealth, your business, and your family's future.
As we've seen, the rules are precise and the stakes are high, but the opportunity for smart planning is really significant. So if you're a business owner thinking about those 2026 changes, or if you just want to see how this could benefit your estate plan, the next step is to have a confidential planning review. Get in touch with us at Pro Tax Accountant to get started. You can call us on 07-985-68-9912, or you can email info@protaxaccountant.co.uk. And please do subscribe to our channel for more expert tax insights just like this.
And finally, just the important disclaimer. The information we've provided today is for general guidance and educational purposes only. It doesn't constitute professional tax or legal advice. Tax laws, as you've seen, are incredibly complex and they are always subject to change. So it is absolutely essential that you consult with a qualified professional to get advice that is specifically tailored to your personal and business circumstances. Thanks for watching.